Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Dan Kennedy. Thanks for being on the show, Dan.
Whitney, thank you for having me. Big fan.
Thank you. Thank you. Dan has been actively investing in real estate since 2011, focusing on single-family homes in attractive neighborhoods requiring improvements to optimize rents and long-term value in 3 separate markets across California and Texas. He's an accredited limited partner in a $34 million student housing development project in downtown Los Angeles, recently retired from a 12-year professional soccer career where he most recently played for the LA Galaxy. He is passionate about educating all professional athletes on real estate investing and the tremendous benefits of establishing a strong real estate portfolio leading into life after an athletic career. But Dan, you're now in the syndication business as well, isn't that correct?
Yeah, and that's, thank you for the little tidbit in history to reflect on. Make me 40th birthday is right around the corner, so you're making me feel it. Really, Whitney, I started off knowing that I wanted to create passive income. And the one certainty was that as a professional athlete, you just never know when your career is going to end. And you know for certain it's not going to be long. So my whole goal when I started to make a buck was to purchase cash flowing homes. And that opportunity was huge in 2011. And as you experience and you grow as an individual, my mind has shifted and changed, and there's a real reason why I'm no longer investing in single family homes and why I'm investing in commercial real estate. And it's just because you have the ability to achieve scale, and you can purchase higher quality assets that have a better return profile and a more consistent expense on an annualized basis, a more consistent expense level that helps you understand what your return actually is going to be. So it was fortunate timing in 2011. I was buying a lot of things at discount. Didn't mean I was any good at what I did. It was just it was a market opportunity. And now Matt, Shamus, and I have we started Driven Capital Partners a few years ago, and we're syndicating and raising capital and putting deals together.
Awesome. I was just telling you, we were talking about this before we started recording, just how, we've had a few professional athletes on, and I just think it's something, whether it's professional athlete, whether it's military, it's like that drive. And maybe Matt even talked about that, which just so the listener knows, Matt Shamus, his partner, was show number WS 536. And it wasn't too long before this show is airing. So I would encourage you to go back and listen to that as well. But just the driven part of Driven Capital Partners, that's interesting.
Well, we were, our wives are best friends. Matt and I's wives are best friends, and Matt and my wife grew up together in Stockton. So we bought a lot of homes in Stockton when it was so depressed. And we were on vacation. Matt and I have been working on Driven Capital Partners for a handful of years, and we were both in the same point in life where we were ready. I knew I was retiring from soccer. I was finishing up my MBA at USC. And he was ready to exit Facebook. And we were like, well, we got to come up with a name. What's the name going to be? And there's one common denominator to both of us is we have the drive. And so we're willing to hustle and work hard. And that's what we enjoy doing. So it's helped us create a little bit of a portfolio to date, but we're definitely excited about where we're going.
Yeah, tell me a little about your all's roles there and what that looks like. I know a lot of people that are listening are maybe just starting a partnership, or maybe they've started one, and and that's always a question I get often. Well, what do you do, and what's your partner do, and
right.
What does that look like?
Well, it's the key to whatever success we've had to date is how we are able to work together. And this is one thing we've identified just early on in our friendship, was like, we're two very different people. We think differently. And the skill sets that we bring to the table are complementary to one another. And so what it's turned out to be is Matt was an investment banker directly out of undergrad. He's got a really strong financial acumen. I went to business school, picked up my finance in business school really, and I've sharpened the pencil and gotten more comfortable in my underwriting. But Matt leads our underwriting and our acquisitions, and we will both identify assets through our network of friends in the industry. And in the end, Matt's the one that's got to take the reins and really dig into the analysis of how the asset's going to perform. And on the back end, once the property's acquired, that's when I take ownership of it and do all of the asset management, investor reporting, take care of the properties and the property managers, and drive the strategy behind what we're trying to achieve with the business plans that we've set out. And then we both do, we both go out and raise money. And, it's funny because every single deal we set out, we're in contract on a deal in Boise right now, we're raising money for, and you never really know, where the capital stack's going to end up, and you never really know who's coming in on the deal. And that's one of these things it's exciting and exhilarating about what we do is every property, every asset's its own investment, and every deal presents its own unique opportunities to get out in front of people. And end of the day, we've both done a decent job of striking this chord of raising capital. And it's key in this industry right now.
No doubt about it. You got to have the capital, or you definitely do not have a deal.
Right. Well, that's how we started. We started saying, okay, well, our first deal, we're going to go out and we're going to buy. And if it's just Matt and Dan buying it, we're okay with that. We're going to share it with people. We're going to try to raise some money, but we felt like, okay, we'll backstop this. And in fact, that's kind of where we've gone. It's like, okay, we know we can backstop this a certain amount. So if we can go out, and we'd prefer to raise 90% of the equity needed, but if we have to raise 60, that's okay.
What does your all schedule look like? That may be an odd question, but sometimes I get that, like, well, Whitney, how do you maintain a schedule, and you and your partner, and what does that look like, and how do you are you off in the afternoons at a certain time, or do you get to spend any time with the family? Just quickly, what does that look like for you all?
Well, Matt's in San Jose, I'm in Long Beach, so we're not down the street from each other. But what that means is our days start and end from a business perspective on the phone with one another. And it's good. It's a good way to kind of flush out your thinking for the day and set some expectations. My days typically start about 5, and we both have young kids. So it's about managing all of that. And I try to get some think time in the morning, help out with breakfast around the house with the kiddos, have a little bit of a workout, and then by 8:00, really off and running. And typically I'm just planning on 8 to 4:30, not leaving my desk unless I'm going to meet with investors or see a property, or whether it's a property we want to buy or we manage. So, and then, I try to check back in with the family around 5, just because of the nature of our kids right now is, about 7:00, they're heading to bed anyway. So good. And then it's after they're down, it's back and just kind of check any oversight. And if any creative work needs to get done, that's the time to do it. And so when you think about, like, we do everything, Matt and I, we outsource some key roles, but for the most part, like right now, I'm building a deck on some apartments in Paso Robles, California. And so you just kind of prioritize, well, if we're working on some refinancing, then the majority of that work needs to happen in banking hours, right? So just shifting your schedule to execute what the tasks that you have in front of you. And right now we're in the bootstrap and growth stage of building a big business. Big, not in the amount of people that we want to work for us, but in the scale of real estate we want to own. And it's just takes a little bit of work, and we're okay with that. We're comfortable with that.
I wanted to briefly mention or back that, one thing you mentioned about multifamily instead of single family or switching to that from single family, you said more consistent expenses.
Yeah.
And I haven't heard many people say that, but I would agree completely. But I just thought that was interesting.
Well, the only reason why I have that perspective is because I've experienced it. And I just sold a house in Stockton that I purchased in 2011, and I sold it a month ago. Okay. And it was like purchase $100,000, sell it for 250. Unbelievable investment. You can't find that opportunity in the marketplace today. And that deal worked all day long because mortgage, tax, and insurance on it was like $600 a month. And I just knew we could rent it for $900. Well, that's all good until you have people move out. And when people move out, it's like, well, the fence, the this, that, the other. And you don't, as a single family homeowner, you don't often forwardly project your expenses. And so it can dig into the returns. Another property, beautiful home in Plano. Unbelievable, like 3,000 square foot, single story home, 12-foot ceilings, like really nice rental property. And with how that town's growing, you have executives moving there that don't want to buy right away. They have to adjust the town. And it was right next to the main hospital, the tech hub in Plano, fantastic location. And we had the sewer line break, and sewer main breaks, and you're like, oh, okay, insurance will cover this. No, it's below slab. It's outside of the shell of the home. $18,000 later, I'm like, man, this property cash flows $1,200 a month. $18,000 later, and you're now scratching your head, going, man, that just wiped out, a year and a half of return. So, insurance policies and commercial real estate are stronger in stance than they are in residential, and we purchase triple net lease deals where the expenses are all on the tenants, and that's perfect. And then in an apartment game, you can go and little tricks to, maybe decrease some expenses and offload those to the tenants. And often people are purchasing thinking where they can take rents. Well, we've been in any trouble we've ever been in is largely because of the expenses.
Yeah, no, I just thought it was interesting because I don't hear people highlight that much, and I would agree. I mean, we account for so much more than I ever thought about accounting for when I was doing single family many years ago. I don't know why we didn't, but I don't know. We did. Maybe just growing a larger business is made us to grow just in the entire business, including that as well. But moving on a little bit, I'd love for us to talk about just the obviously the current state of the market a little bit, but just what this, the impact of the coronavirus, all that stuff has had on your all's, operations, and maybe give us some, how it's impacted some current assets. And we'll talk about how you all are moving forward as well.
Yeah. Well, this is, everybody had the sense that something was coming. We just didn't know what it was going to be. And the one thing, 4 or 5 months ago, we all thought strongly about was that we as an economy domestically were not in a position where the financial markets were going to collapse like they did in 2008 and 2009. So expecting that it was going to be something different that derailed us, how we approached all of our acquisitions was to raise extra equity, which reduces the return profile for investors. But we did it because we wanted strong cash in our accounts in the case that the property didn't perform as we expected, or something in a macroeconomic impact happened. Well, coronavirus comes into our lives, and I'd say 6 weeks ago, I was like, I'm not sure how bad can this be, and the harsh reality now that in California, we're going to be on lockdown through May at least. And the thrash is real on real estate. And in this scenario, real estate is the lagger. It's not going to be the first one that's hit. The reality is, our April our April collections have gone fine. But my concern is that May, June, July is going to be really hard. Companies are going to be, does this stimulus package do what it's supposed to? Does it give them enough liquidity to continue to do business? And so we purchased some medical offices in which I'm like, man, Matt and I's thesis is to acquire a variety of asset classes and a variety of growing marketplaces. We want to be diversified in market and asset class. And this is the exact reason why when something happens, you think, oh, I'm going to be insulated well in medical offices. Well, medical office in a recession, people have to go to the dentist. They have to go to the doctor. These things, no, the dentist has literally been shut down. So there's just two of us at Driven Capital Partners. And the one advantage we have is there's no red tape here. We can make quick decisions. Okay. So what do we prioritize? Well, right now we're early owners in some of these properties. We prioritize the relationship with our tenants, and we need to make them feel like this is a true partnership. The only way we as owners succeed is if they are successful in the space that they are in. So we immediately said, hey, what do you need? If you need 3 months of rent abatement, we got no problem giving you that. We'll build that into the remaining term of your lease, and we'll amortize it over that term. We don't need the $15,000 up front. We can build that in over 24 months. Hopefully that gives them the ability in the near term to keep things together in order to get their business back up and running, because they were thriving before this. And on the back end, strategically, they're going to be paying a little bit higher rent. So when it becomes renewal time, we'll be a step closer to where we need to be from a lease up perspective. Vacant spaces, you really can't do anything about in this time. We have a war chest of tenant improvement capital, so we can hopefully be the most competitive player in the marketplace when people are looking for spaces to lease. And then in our apartments, the apartments are probably the trickiest one because it's people's livelihood. There's been a lot of local and statewide eviction clauses, and the last thing you want to do is kick someone out on the streets when they don't have a job and we don't know where we are with this pandemic.
And you also know that a vacant unit's not going to pay you any money.
That's right. So can we provide some, hey, if you pay on time, you get $50 off incentives? Can we be creative in how we think of activating these tenants? And then in the instance that they say, hey, we can't pay, we haven't crossed that bridge, but our expectation is going to be like, hey, pay what you can today. And we'll probably go back with the same philosophy of, once this ban is lifted of social distancing, and businesses can now start up again, then there's got to be some rebate. They have to work their way back to even. And by us offering this olive branch, we're putting ourselves at exposure. But what's the alternative?
Right.
What is the alternative?
I like the, first thing before anything like this happens, I like how you mentioned that you all are raising extra equity, when you're purchasing just as a reserve budget, I assume.
Right. That's right. Exactly right.
Do you all have a specific way you all are calculating that, or is there a certain way that you say, okay, this is how much we want in reserves just in case something like this happens?
Well, a few things. We like to buy commercial assets that are below market rents, but not just to take them up to market rents. There's a certain stickiness to tenants when they look around the marketplace and understand that they're actually getting a pretty good deal. And if we're prioritizing operational efficiencies and we're buying what we think are in growing markets at reasonable cap rates and getting good debt terms, then we can capture that cash flow. And that's what we're doing. Now, we have to be prepared for tenants to leave. That's the reality. Some tenants are, whether they want to leave or not, they're going to have to because they're growing or they're shrinking. And so the reserve budget acts in two ways. One, if coronavirus runs rampant and business are closing down and we go dark, well, we can service our debt for, in some cases, almost a year. And then you can also think about, do I want to be a lease discounter? Do I just want to get someone in the building? And then on the other end of that, you typically have some lead up to tenants moving out. If you're thinking about commercial tenants, and then you have 9 months to go market the property. You also have the ability to say, hey, if you think this needs to be a custom build out, we got a couple $100,000 we could float your way. And typically there's not a lot of, if you're thinking about Boise, if you're thinking about Huntsville, Alabama, we like these markets because of the dynamics that are happening there and a growth that's happening there. And we also think we can compete really well in this like sub-institutional size commercial real estate investing. And then on the apartment side, the reserve budget is gold because you can flex. The thing I love about apartments is you can flex the strategy muscle quickly. So, hey, we're not leasing up at $895 anymore. Okay, why not? What's changing? Let's go figure this out, and we can deploy a whole new leasing strategy next week. No problem. The other thing is well, we thought the value add plan was going to work, and it's not. We're not getting the return on our investment. We're going to hold in cash, and we're just going to try to optimize our expenses and push rents $20 a month or $20 a month every time a lease renews, and just focus on stability. And now we have a big war chest in case something goes wrong.
I couldn't agree more. I mean, we do the same thing. And I told this recently that I was, there were some people who've been doing this a lot longer than me who really questioned our reserve budget on this last deal that we did because it was so large. Okay. And we closed just over 2 weeks ago on this really large property. And, that was like right when all this was happening, like right when it was really coming out, know? And so now I am so grateful, that we had as large a reserve budget as we did,
right.
And so anyway, I could not.
Well, you certainly sleep better at night. And the reality of the service we're providing is that when there's a problem at the property, we get to go solve it. And then it shows up in a quarterly report to investors that they don't have to deal with the brain damage of solving this problem. Well, typically it's a lot easier to solve a problem when you're not pinching pennies. And to your point, Whitney, the reason why we overraise is because we want to say, hey, listen, as an investor in our deals, if we cut down on the equity requirement and we just went out and got what we needed from the bank and we're like, the property's going to cash flow a little bit, your return may go from a 17 IRR up to a 21, which that sounds great. But the problem is, the last thing you want me to do, Whitney, is call you and say, hey, Whitney, we're a little tight on cash. Things haven't been going real well. I need another 10 grand. And we're doing that from all of our investors.
Right.
It's going to hurt a little bit more, so we prefer let's be cautious. Let's raise a bunch of extra capital, and it's going to reduce the return for those investors, but it should be a risk adjusted return.
Right. Yeah. And I love how you're being proactive as well. And you mentioned, reaching out and saying, hey, if you all need a few months, of rent, we'll make ways to make that work. And you're amortizing that, I think you said, over the next so many months or their, their lease or something like that. So I just think that's great to be able to work with them. And then obviously then maybe they don't lose their business. Cause like we said, a vacant unit, just produces nothing, and that turnover cost as well.
My dad's a small business owner and he is always focused on his variable costs, not his fixed costs. And so in an environment like this, you're immediately thinking, okay, how do I trim my variable costs? But if you can get the benefit of trimming your fixed costs for some period of time, it can be a huge helping hand to staying on your feet. And so that, Matt and we chewed on it for a few days. We didn't know what the right approach was, candidly. And we just decided, hey, if I was an investor and you were managing my property, Matt, I would want you to engage. I wouldn't want to be reactive on this. So let's come up with a strategy, a best case, worst case strategy where you're basically saying, hey, we're going to just go try to make some lemonade out of these lemons. And it's yet to be determined on how this is going to play out. We're taking some risk for sure, because what we could have done is just said nothing and expected all rents to be paid.
What is this? Before we run out of time, we don't have too many minutes left, and got a few more questions that I want to ask you. But before we have to get to that, how's this changed? How you all are moving forward?
Dramatically. We had 6 deals in contract 3 weeks ago, and we've asked for extensions on all of them, which means a couple of them fell out because the sellers weren't willing to grant them, which is fine. There's 2 deals that seem to be winners, even amidst the coronavirus. And those 2 deals, we're not in pressure on from a timing perspective right now. And we'll see now I think the next obstacle is raising capital and going back to the same people and saying, hey, this is tricky, Whitney, and I don't know what you guys are doing, but it's prudent right now that cash is king. And so what we said to our investors is, hey, we can make quarterly distributions in Q1, but we're electing not to. That quarterly distribution to you will accrue, but we don't know the impacts of the coronavirus. So how can we go and just start sending out quarterly checks? It seems irresponsible. We haven't had any pushback. Now, at the same time, we're going and saying, hey, we're going to raise money for new deals. And these deals have quarterly distributions. But the difference is the properties I bought in December, I underwrote conservatively, or Matt underwrote conservatively, and in the instance something crazy happened. Well, the benefit we have today is that on a Boise property, for example, we can say, hey, we want a year lease guarantee from the seller. There's different things that we can do now to understand or mitigate the risk of the coronavirus. And that's why we're still buyers, right? And so there's 2 deals. One of them's a vacant apartment building in Paso Robles, which is just there's 3% vacancy in the submarket. It's unhealthy. They need housing. And this is a vacant building because there's a slumlord issue, and we got the opportunity to go and value add it. And it's in an A you're talking about a C- property in an A location. I mean, that is the perfect scenario for us.
Nice.
So this has challenged us, it's challenged our thinking with how we talk to our investors and how we message this. It's challenged us in the decisions we're making on distributions and operations and our tenants. And now we thought we were going to go cruise and raise a bunch of money for 6 deals. And now we're saying, well, hold on. Let's extend, let's get time, let's collect data, let's make good decisions. But we're still buyers. And I think, there's going to be some opportunity coming out of this. Unfortunately, it's going to hurt some people, and we're just trying to make sure it doesn't hurt our people.
Yeah. I've heard lots of people in the industry and have reached out to me as well, asking about, well, what are your investors saying? What are your, are they still on board? Do you think they're going to, be on the next deal? And I interviewed a guy not too long ago, and he's been doing this for 20, 30 years. And he said during the .com boom, he was able to raise like $40 million. Then all of a sudden it was 10 million, so, and I just say that to say, you do have to know your investors pretty well and have a pretty good pulse, on that. But now, especially before you go enter into the same, maybe size of deal that you would have 2 months ago.
Right. Yeah. And we should expect some price adjustments. I think sellers' expectations, depending on what position they're in, is probably adjusting by the moment. And the one thing we did was we just called our investors. We called each of them. Hey, how you doing? What's going on? How are everyone healthy? How's this impacting your work? How's this? And let's get an understanding and humanize this. And that also allows us some time to reflect and judge what we think we can go do. And there's still interested investors out there as well. Because I would say, Whitney, probably because of what's happened in the stock market. Mm-hmm. This seems, I still think like the investment we have in Boise is just going to clip 7-8% return for 5-6 years, regardless of coronavirus. I truly believe that.
What type of property is that, if I can ask?
It's a flex office industrial property. And so you have like 25 or 30% of the building is office space. And then you have high bay in the back. It's great, beautiful building built in 2003, downtown Boise, great market. Both tenants are prospering and they're in light manufacturing. So they're both operational. And we want to enter that market. We feel like this is a conservative first step. So we identify a market like Boise, go purchase this property, and then we'll go try to gobble up 4 or 5 more properties there in the next 18 months.
All right, Dan, just a few more questions. We're pushing the time limit, but what's been the hardest part of the syndication process for you?
Well, it's, we are learning every single day. Every single day presents new challenges. We are going into an uncertain world, Matt and I. We have young families. We are bootstrapping driven capital partners. We come up with all the earnest money deposits. We go through due diligence costs. That means if we pull out of deals like we did last month, that cost is burdened only out of our pockets. And so, we have a strong sense of belief on where we can take this. And we're betting on ourselves here. And there is stress that comes from that, from a family dynamic. We have very supportive wives. But the reality is, until we start selling our assets, we're not really making a lot of money. And so it's really focused on how we can trade our current portfolios of single family homes, use that liquid capital to now go and scale up and purchase higher quality commercial assets, and then leverage that with our relationships and raise capital and make deals happen.
What's a way that you've recently improved your business that we could apply to ours?
Well, I'm sure you use an investment software.
We do. Yes.
Okay. So we just, we took the leap with AppFolio's investment software, and it's been working really well. I think it's professionalized our business without a doubt. It's streamlined some of the communications and how we present ourselves. There's a little bit higher barrier of entry there for some people. You have to log in, but once people learn the technology, it's a powerful tool. We have a bookkeeper. We're trying to outsource these things that that have to get done, but they don't grow the business. So that's kind of how we're thinking about it. Okay, well, if we need to outsource maybe some marketing work, someone to help us put a deck together, these are the things that we'll go and we'll give them all the information and let them run, and let someone far more creative than me create a pretty deck.
Yeah, that's a neat way to look at it. Things that have to get done, but maybe they don't grow the business. I mean, ultimately, I guess they are kind of growing the business, but it seems more monotonous type work, doesn't it?
Yeah. So, I mean, that's what we really focus on. Okay. The 3 things that we need to focus on here are managing the assets that we own, identifying and acquiring new assets, and raising money. Like to just simplify everything. Those are the 3 focus points every single day. And I think we each touch each one of those verticals every single day.
I like that. So tell me the number one thing that's contributed to your success.
Well, success is never overnight, and it never comes easy. I've seen such a variety of successful people, whether it's in sport, whether it's in school, whether it's in real estate, and the one common denominator is always hard work. And now you get to the point where, okay, you've learned the business, you understand how to put deals together and syndicate, and but that doesn't mean you can get comfortable with those processes. How can we make them better? So it's just in this. We're always trying to achieve, growth and have that growth mindset and be team players. So yeah, I would say we just got to continue to work hard, work smart, and take this. I mean, these obstacles like coronavirus give you a little bit of scar tissue, but it'll make you better.
How do you like to give back?
Well, time. Time is the most valuable asset we all have, and right now really prioritizing working efficiently. And the give back immediately right now is inwardly focused on my kids. So it's a great thing. And I just want to make sure that our family dynamic is not lost in the growth of our company right now. I think that's the near-term focus.
Love how you said that. You don't want the family dynamic to be lost in the growth of your business.
Yeah. We got a good thing going.
Yeah. You'd be sacrificing a lot more.
Yeah, that's right.
That's for sure. So appreciate your time, Dan. Thank you so much. We've been from why multifamily over single family to partnerships and your all's roles and just the whole coronavirus issue and how you all were prepared for that with the reserve budgets and even how you're being proactive in that as well. I appreciate you just explaining that. But tell the listeners how they can get in touch with you and learn more about you.
Well, Driven Capital Partners is our company. Our website is drivencap.com. So www.drivencap.com. My personal email is dan@drivencap.com. You can reach out to us. Matt and I are always looking to grow our networks and just become better. So we're happy to continue to learn and meet new people and just build the relationships. Because that's actually the beautiful thing about real estate, Whitney, is it is such a relationship-driven business.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.